You got the pretty pictures I sent you there, Juicy?
I already had him, brother. I already had him. Did you see the link I sent you, dog?
All right, all right. I don't click
Yeah.
links. You don't read emails. I don't click links.
Hey guys, JC Peretz here, founder of AllStarCharts.com, and I am joined once again this beautiful Wednesday by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
Beautiful indeed. Here in Colorado, it's snowing like crazy. That's the way we like it.
It's raining over here in the Northeast. It's one of the uglier days we've had this winter, but these ugly days that we have had have come with some ugly days in the market. And with ugly days in the market, implied volatility goes up, which means the premiums that we could potentially collect also go up. It's up to us as investors to either go collect that cash or not. And we are choosing to do so. Are we not, Mr. Sean?
We are indeed. On days like this, as you know, and people who know me know, I like to go on the hunt for ETFs that are displaying high implied volatility. And when I did that this morning, JC, I came across the XHB, which was far and away showing way more implied volatility than every other ETF that I track. And as if that wasn't good enough, the best part is if you pull up the chart here, we really have some clearly defined levels we can lean against and get good premium to sell in April options. And so that's what we're doing here today with the,
More
with
than
the
I
XHB.
thought. More than I thought, for the record. I even asked you, I'm like, are we getting enough juice to be able to make it worth our while? Because at first glance, I was like, no shot that this is even worth our time and potential aggravation. And when you told me how much juice we were getting, and we only had to go out to April, I was like, okay, done, deal.
Right. Yeah. So when I'm selling premium, I actually just got a question about this from someone in our community just minutes ago. So I'll explain what I said to him, and he asked me, why April? Why not sell March options? And look, there's nothing wrong with selling March options if you want to, but for me, I generally like to establish short premium plays with anywhere from 4 to 8 weeks to go until expiration. That gives us enough premium to make it worthwhile. And the problem is when you get closer to expiration, which March expiration is now the front month in futures trading terms, right? If now that we're in the front month, those options, yes, they will potentially decay in value faster. However, that comes with added gamma risk. And what gamma risk means is those options are going to be much more sensitive to price changes. So if XHB has a sudden move in either direction, March options will move against us a lot quicker than April options will. So that's the answer. That's the long-winded answer I gave to the guy about why we're doing April options.
I like it. And again, surprising. I mean, to me, before looking at the implied volatility, that it was where it was. So I really love how we sort our ETFs by implied volatility. And sure enough, and when you said 73s and 60s, I was like, man, we can go that far, out of the money in both directions, and get that juice. And you're like, yep. I was like, man, done deal. So what we're doing is we're selling the 73 calls in April, and we're selling an equivalent amount of the 60 puts and collecting that cha-cha. What is it? $190, $180?
We put this trade on this morning. I got $190 for it. It's currently, I'm looking at it right now live. It's currently trading about 178, 180. So it's moved our direction a little bit, which is to be expected because it's gone sideways. But look, Fed stuff's coming out here shortly. These premiums could go way higher or way lower depending on what happens, or maybe nothing. But the most important thing is we like these strikes. We like the strikes not because of the premium we got, although the premium is nice. Ooh, that just popped in the chart there. Very nice there, JC. But those levels are significant levels, right? I mean, look at 73. When XHB was rallying with everything else in the market to start this calendar year, when it got to 73, it was resoundingly rejected. So that level speaks to me as being an important level. On the other side, that 60 level was very significant support coming into the end of last year. I expect both of those levels to hold at least for the next 2-3 weeks, which is all we need for us to make some money in this trade.
All right, let's talk about taking profits. We
Sure.
could buy back this strangle for half of what we were able to collect today. Call it a
Right.
day and move on?
Yeah, so the credit that we received today, that's the most we could possibly ever make in this trade if if both options expire worthless. However, that's not the game I'm in when I'm holding naked risk, okay? We have theoretically unlimited risk when we're holding naked options, and that's something that I don't take lightly. So in a trade like this, I am always leaving a resting good till cancel order to close my spread down at a profit when I could buy it back for half of what I collected. So I sold it for $1.90. I'm looking to buy it back for about 90 cents, 95 cents. If I could do that, I will take that profit and move on to the next trade. It's not worth holding on for that extra dime, that extra nickel, and another whole month where anything could happen in the markets. Anything can and will happen in the markets.
So this is one of those opportunities that we look at where the probabilities of success are higher than a lot of the other types of trades that we were to put on, right? Asset prices trend, know that. So if you're investing in the direction of the underlying trend, your probabilities of success are going to be greater. In volatility mean reverts, right? So that's what we're betting on here. And we're betting on this sort of messy looking chart to continue messy. We're going to collect that income. So is it going to make our year? Is it going to change our lives? No. Is there a high probability of success that we keep all the cash we collected? The answer is yes.
Yes.
Now, let's say in the off chance that we actually get this wrong and prices exceed either of those strike levels, whether it be 73 to the upside or 60 to the downside, what happens then?
Any closing price above 73 or below 60 is my signal that I'm wrong. I was betting on range-bound action, and that is undeniable proof that the range is now expanding, and I am wrong. And so I will want out of the trade, win or lose. Likely it'll be a loss, but it potentially could be a win depending on the timing of when that happens. Either way, above 73, below 60, I am out. That's the P&L graph there that JC is showing. Shows you the range of prices over which we are profitable. And by the way, let's throw this in here real quick, JC. For some traders out there, they're uncomfortable selling naked options, right? They're uncomfortable with the potential of unlimited loss. Maybe they have a smaller account and they don't have the available margin, or maybe they just want to have less margin tied up so that they could do other trades and diversify their risks. If that's the case, you can always convert this strangle into an iron condor by just buying cheap out of the money calls and out of the money puts. That will define your risk and make the margin requirement much more manageable, much more affordable. And you could still participate along with us in this similar trade. The only difference is you would have a resting order to buy your spread back at a cheaper price than we would, because you're going to have a little bit less credit in the trade depending on what strikes you purchased. But at the end of the day, whatever credit you received net for putting the trade on, you want to buy it back for half of what you received today.
All right, so let's clarify a couple of things. So what we are doing is we're selling the strangle. So that means that we are naked short the 73 calls in April. We're naked short the 60 puts in April, collecting $1.90. We could buy it back for half of that. We will immediately. And if at any point the price closes above 73 or below 60, we unwind the trade. We're wrong and we move on to something else. That is what we're doing. In the case that you do not want to be naked short, in the case that your broker doesn't want you to be naked short, in the case that you want to use less capital so that you could do other stuff with your portfolio, if any of those fit your description at all, what Sean is suggesting is the option, pun intended, to add the iron condor, where you are buying a further out of the money call and you're buying a further out of the money put. My question to you, Mr. Sean, if you are in one of those cases, any thoughts on which strike to do so in? And also, all of that remains in April, correct?
All of it remains in April. As far as the strike goes, I'm not too particular on what the actual strike is. I'm more particular about what it costs. In a perfect world, I would just buy nickel options, right? I buy a call that costs me a nickel and I buy a put that costs me a nickel. Maybe I pay 10 cents, maybe I pay 15 cents. But either way, I want it to be cheap. I'm not so worried about the strike, because really all we care about it.
You don't want to go too far out either, right? Too far out of the money, right?
Well, look, we're not buying the calls because, or we're not buying the options because we are thinking that That's where we want to define our risk. We're really just doing that to make the margin clerks happy, right? We were doing that so that you can afford the trade. The real trade here, even if you have the iron condor on, the real trade here is still the strangle. You're still just managing the strangle. It's the short call and the short put that matters.
So the strike itself matters less. It's existence alone that solves all of those other problems.
Exactly. So rule of thumb, maybe go $5 away, maybe $10 away on the strikes, and you'll probably only have to pay 10, 15, 20 cents for those options. And it's a small price to pay for peace of mind.
And a happy margin clerk.
And a happy margin clerk.
Nobody wants an angry margin clerk.
No, those are not calls you want to receive from any.
Right,
you never want to hear your margin clerk's voice. That's not a good thing.
That's right. You don't want your margin clerk to know your kids' names. So we are selling a home builder's XHB April 6073 strangle. That means we are naked short the April 73 calls on XHB and short an equivalent amount of the April 60 puts. If you want to put on the iron condor, knock yourself out. We're sticking with the strangle here. I really like this trade a lot, Sean. Usually when we do this, we go back and forth a couple of times. You know, you push me, I push you, push back on what each other are seeing or thinking, and then we finally come to a conclusion. In this case, we agreed pretty quickly. So, one for us in terms of simplicity. Just collect that cha-cha. Market's been a mess. It's a good time to do this sort of thing. So I'm with you.
All right, JC, I know you got a meeting to get to. The Fed's about to talk, or do something. The Fed's about to do something. I don't know. I don't pay attention.
Always doing things. They're always talking. They need to shut up for once.
We better get out of here.
Adios.